Let's dive into the markets and bring in Katie Koch, Goldman Sachs Asset Management Co-Head of Equities. Katie, thanks for joining us here. Listen, earnings season has not been good. We've seen some earnings beats, but you have a lot of companies withdrawing guidance, cutting dividends, no longer buying back stocks. So my question to you is the market simply overvalued here? We've seen a big run from the March lows, but it doesn't seem to jive with what's happening this earnings season.
Yeah, this is a question we're getting. So first of all, Brian, thank you so much for having me on. And this question you asked is the one we're getting from all of our clients. With the S&P trading just 17% below its all-time high, has the market run too far? I want to make a couple of points about that. And our answer, the headline here is that we think the Fed's providing a lot of downside, and that active management can help you find the upside. But a couple of specific points to make. One of the most important rules of equity investing is not to fight the Fed. And the Fed has established clear credibility on the do whatever it takes front with almost $3 trillion of balance sheet expansion. And to put that into context, my partners in fixed income believe that the balance sheet is going to go from 20% of GDP at the start of this year to 40% at the end of the year. And the Fed obviously can't fix everything. It's a health crisis, and we do have a real economic challenge here. We've lost in the last 5 weeks jobs equivalent to the entire size of the Australia population. So we need some pharmacological breakthroughs and actual growth. But in the interim, the sheer volume of monetary support is really reducing the left tail risk here for equity markets. That's the first point. Fed's providing the floor. The second point I want to make is that we think investors should consider the possibility that the market cap weighted indexes like the S&P, which are dominated by these big tech names, are actually distorting the picture of overall resilience. So while the S&P is 17% below its all-time high, there's lots of stuff happening underneath. The 5 largest stocks, Microsoft, Apple, Amazon, Google, and Facebook, are now 20% of the S&P. That's more than the top 5 stocks at the peak of the tech. I'm not saying that we're in a bubble. These are great companies. We own some of them. But these tech names are really distorting the index. They've got the fortress balance sheets and business models that are resilient in the face of COVID-19, and they're only down 11% from their highs. However, if you look at the median stock in the S&P 500, it's 28% below its highs. And then the final point I would make here is that the dispersion of stock return, how different they perform from each other, has spiked to its highest level since the global financial crisis. And if you pull all of that together, our conclusion would be stay invested in equity markets. The Fed is providing somewhat of a floor here, but you need to be aggressively active in the pursuit of opportunities at the company level.
Katie, if a lot of the positive momentum is sort of concentrated in these few large cap stocks that you pointed to, most of those tech names, how real are the rallies we've been seeing? And is there conviction on the part of investors right now?
Yeah, I think in order to find the best opportunities in equity markets and the most upside from here, you are going to have to look beyond the mega cap names that you just mentioned. However, we don't think you need to look as far as deep value or distressed names, for example, in energy and banks, to find meaningful upside. Instead, we think actually a great place to hunt is companies in the middle of that spectrum that have two things going for them. They need to have the balance sheet strength to manage through a protracted shutdown, because the reality is none of us know how long this is going to last. And then second, they have been inappropriately discounted relative to the recent market sell-off. So if you're interested, I could walk through some examples of where we see opportunities for recovery. Would that be useful?
Yeah. Katie, that would be great, because I think what you're talking about here are the small cap stocks, that Russell 2000 index, which we haven't been talking too much about. Do you see opportunity there?
Yeah, so the small cap part of the market is a great place to hunt for some of these recovery ideas. And I would say almost every investor listening to this program probably owns more of Amazon, Google, and Microsoft than the entirety of the small cap market. So why should people own more? We really think small cap, and in particular the growth part of the market, has a very strong combination of price and prospect. So this part of the market's still down almost 20% since the 19th of February, when we had the inflection point. And they also tend to lead coming out of recessionary bear markets. On average, the Russell 2000 growth index has generated returns of 63% over the following 1 year from the bottom of a bear market, outperforming the S&P by 20%. And then just second secondary point on that is that these companies have great prospects. They're more exposed to cutting-edge, technology-driven trends that are creating disruption across lots of sectors in the market, and less exposed to deeply cyclical and challenged parts of the market. So a favorite area for us within the small cap space is genomics and precision medicine, which we think is one of the most exciting investment themes over the next decade, good for investors as well as humanity. There's only one major genomics player in the large cap space, and it's covered by 25 sell-side analysts. If you hunt in the small cap space for these types of names, it allows you to play the entire genomics value chain, gene sequencing, gene editing, the supply chain. For example, we own a company that makes 70% of the rubber stoppers used in biologic drug packaging. And that small cap is so great because it gets you that opportunity to play in less known parts of the value chain. And these companies in kind of the less than $10 billion part of the market cap are less covered by the sell side. So that's a place where you still have price dislocation and tremendous forward prospects. I'd also say, and I'm happy to talk about it, there are some parts in the larger cap part of the market that are more dislocated than the tech giants too, and we're playing some recovery themes in that part of the market too.
Katie, you're a fundamental analyst. You look at the fundamentals of companies. How disturbed are you that you're seeing companies come out here and just completely do away with their dividends? And then secondarily, do you think those dividend streams come back from these reputable companies?
So my answer, I'll answer the second part first. We absolutely think that people will reinstate their dividends. And as an equity investor, actually cutting a dividend, if you're doing it to shore up balance sheet and create liquidity, is actually can be a very positive thing for companies, because the number one thing now that you need to know as an equity investor is to have conviction that that company has the balance sheet strength to manage through a shutdown that none of us know how long it will last. So we're actually big fans of companies using all the tools at their disposal to build up the liquidity on the balance sheet. And we expect it to be temporary. We think the highest quality companies will actually emerge from recession, in fact, many of them stronger, and we do expect them to reinstate their dividends. If you are interested in equity income, I would say, and you use an active manager, you can actually still build a very diversified, high quality portfolio yielding a percent or two above the broad market if you are focused on stock selection. So yes, many companies have cut their dividends. We're fans of people having the liquidity to make it through the crisis. And I still do think you can find interesting equity income ideas if you're selective about it and don't overreach for yield.
All right, let's leave it there. Katie Koch, Goldman Sachs Asset Management Co-Head of Equities. I'll just say this, Katie, you're my new favorite strategist on the street. Thanks for joining us.
Thank you. Thanks for having me.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.